So today, as part of the culmination strategy, we wanted to talk about one strategy within the culmination is, and we call it the matrix. We talked about some of the trades we did yesterday. We did a meta trade. We had to roll out our Google trade, which is in the matrix. That what we call the matrix right now. And by the way, before I forget, remember you can buy the culmination strategy on Amazon. You can buy it in print, and you can also buy it for Kindle digital. And also, if you like this video and you find this video to be helpful, please like and subscribe. So we can build up our audience and get more people to support or financial advice. So in the matrix, what we're going to do, we're just going to go through our complete options trade that we did with Google. So maybe about a year and a half ago, we bought Google for $92 a share. And then we decided, because we're trying to raise capital right now, we decided that that Google is one of the shares that we're willing to sell. Some companies we'll never sell, like Amazon. We never want to sell. Meta, we never want to sell. Berkshire Hathaway, we never want to sell. BlackRock, we never want to sell. But Google is one of the ones that we're willing to sell, and we'll take that capital and we'll start selling T-bills, even though Google more than likely may keep going up. But we believe that the stock market is just completely overvalued based on value, and so we want to make sure that we're ready when the market do turn. We want to make sure that we're ready, and as part of the downside of the culmination strategy. And what's really weird is you think this will be an exciting time because my stocks are a majority of them are up. We're doing pretty good. We're selling calls against some of those positions and bringing in more money. And what makes selling calls on a stock like Google doesn't pay a dividend. So this is a way for you to be able to get some income from your positions that you have in Google. But as I said, we paid $92 a share for Google back about a year and a half ago. We decided on the 18th that we were going to sell a call. The stock was about 144. We sold the 147 strike for January 19th. So that was one. So it was January 18th. We sold the call. The options expired the next day. On big companies like this, majority of big companies that trade a lot, they normally have options expire every Friday. So we sold the day before. We sold the day before. Sometimes we may sell a week, but this time we sold the day before, and we were able to sell the 147 strike. And for this video, we're going to say that, for make the math a little bit easier, we're going to say that we're selling only one option. That makes the math easier for me. So at $92 a share, one option, that's 100 shares, would have cost me $9,200 to purchase the shares. So then at $144, that meant that the 100 shares would be about $14,400. And so when we sell the option for 16 cents, it actually brought in $16. And that may not sound like a lot. We're selling a call for $16, but I actually call it money printing. We're not really giving anything up. We'll go through some of the risks that you do put up at a strategy like this. It's very minimal risk for selling a call. And if you do this, remember it's 52 weeks in the year, and if you did it every week and you made $16 every week, we're just for this purposes, we only use it as if we only own 100 shares, and we only have and we're only selling one option. So we would have brought in $16 for that one option. And if you sell it every week, so just in 10 weeks, it'd be $160. And if you do it every week, that's how your money add up. And if you have more than just one position, you could really start generating a decent amount of income every week from a strategy like this. So like I said, we sold the call on the 18th when the stock was at $144. The stock, we sold the 147 strike, and we got 16 cents. But on the next day, on the 16th, as it got closer to the market close, the stock price was actually above our strike price of 147. And so we had to actually buy that option back that we sold for 16 cents. We had to buy it back for 59 cents, which would be $59. And it may seem like that we're losing money on this trade, but it's called rolling. We're rolling out. We're actually rolling up and rolling out. So we went from so the strike price was 147, and then what we ended up doing, we ended up selling the 149 strike price, and we sold it for $1.04. So that actually made a difference of 55 cents in that trade. So we actually, on this trade, we actually made $55 from buying back our January 19th call and then rolling out to the 26th, so the next Friday. And what makes this so beautiful is that we got to go up 2 points. So we went up to 149. So if the strike in a week, if the strike price rises above 149 and we allow it to close, then we would have made $200. But if it doesn't go to 149 and it stays below one, let's say it goes to 148, we'll keep the $1.04 that we sold, the $55 difference. We keep that money and we still own our shares. But what happened with me this week, because today is the 26th of January, the stock actually rose up to 153. But we did this trade it was at 152 something. So we actually had to buy the January option back at $4.20. Now that sounds like, man, we sold it for $1.04 and we had to buy it back for $4.20. But because we know they report earnings next week, and they may or may not blow earnings away. If they blow earnings away, the stock may rise. And the stock goes from, it's at 153 now. If they report earnings, it could be up $10. So what we wanted to do is we rolled it out all the way until February 23rd. We wanted to make money on this trade, and we also wanted to move our strike price up to make us make more money. So what we did was, we had to buy it back at 420, the 149 strike. We had to buy it back at 420, and then we sold it. We sold the 155 February 23rd strike, and we sold that one for $4.65. So on this trade of rolling it up, rolling our Google option up and out, we rolled it up to 155. And we sold it for $4.65. So on this trade, we sold it for 45 cents higher than what we had to buy the one back. So we made $45 on that trade. And like I said, so if they report earnings, so on February, they report earnings and they go up. And on February 23rd, or somebody exercised their option, they want to exercise their option at 155. And I didn't do the complete total math, but I'll try to sum it up. And remember, we wanted to sell our Google shares, and it was sitting at 144, but we decided to sell options against it. But remember, originally we sold the 147 strike. We rolled it up and out for this week, and then we rolled it up and out now for February 23rd. So our strike price would have went originally from 147 to 155. So we would have made, so if they call our shares out at 155, we would have made $800 if we only had one option on rolling this option, rolling it up and rolling it out. We would have made $800 and counting that we would have made the $55, the $45, which is another $100, and then the original $16 we made. So we would have made, on doing this trade and wanting to sell our Google shares, would have made an extra $916 we would have made on this trade by entering in the matrix on this trade, where most people just go in and just would have sold their shares at 144. The two bad parts that could occur with this, let's say if they report bad earnings and the stock goes from, it's at 153 now, and let's say it goes from, let's say next week before they report earnings it's at 156. The stock may fall 10 points and be back at 145. But we also have to remember, if you never sold, any options or anything like that, you would still own your shares, so you would still have the same risk. The other part is if they report earnings and it goes up to 175, I would have missed out on $2,000 if we have one share, because I sold mine at 155 and the stock is now sitting, or my strike price is 155 and the stock is sitting at now 175. So I won't get that $20 difference if someone exercises their options. But in most cases, you have all these young traders out there. So a lot of times options are not exercised, and someone may, unless I let them go by the expiration date. So if I decide I may keep rolling it out come February 23rd, if it's anywhere near 155, I may roll them out then. If it's below 155, I may sell more options. But that's how the matrix work. That shows you how you can make money off of not just selling your shares directly. And it's also a way that you can bring in income. And I just use Google as just one example, but you can do this, on any stock. I hope that helps you out. And remember, the Culmination can be purchased on Amazon.com. You can buy it in print and in digital.